Hello everyone, welcome to OptionGig. This is your host Vivek, part-time option trader and full-time worker, husband and father. If you also want to generate consistent monthly income trading options while working in your regular day job, then join me in this journey. Hello busy people and part-time option traders. Thank you for tuning into OptionGig. And the topic for today's session is when to start managing option trades. Specifically in today's session, I will address undefined risk option trades. Now, before I jump into the topic, a brief background of why we are doing this today. If you have been following my channel or my podcast, you would have realized that in recent past, I have done a few sessions on how to manage an option trade that is challenging you, how to manage a trade that has gone against your thesis. Two of my friends sent me a note saying, I understood everything on how to manage it, but I'm not clear on when to kick in those management techniques. What's the right time when I should start using those management techniques? So there I got an idea to create this session. So if you have any questions or you are unsure about a topic, do drop me a note. Send me a note on optiongig@gmail.com and I will come before you to clarify your questions. Alright, so with that, let's dive into today's session. A quick recap, why we manage trades. Because by using our management techniques, we can convert losing trades into winning trades. There are umpteenth examples that I have seen. I have created a few sessions or videos explaining how we manage to turn a big loser into a winner. Or worst case, if you are not able to convert it into a winner, you are able to reduce your eventual loss, and you do all this without increasing any risk on your trade. That's why we manage trades, and I've been harping on this particular topic of managing trades multiple times. Again, I cannot emphasize enough the importance of managing trades. Why most retail option traders lose money in option trading is because they put on the trade and then they are hoping that everything will go their way. They are hoping that their outlook about the stock is right and the stock will cooperate. But we all know, we have been in this market for very long time and we have seen that stock will do what it wants to do. It doesn't care what you think about it. It will chart its own path. So instead of hoping and pinning all our hopes on the movement of stock, we want to learn how to manage our trades in case stock doesn't cooperate. And those who learn to do this successfully are the ones who make money in option trading in long term. Okay, again a quick recap, and that's a prerequisite for this particular session is you should have a clear understanding of the 4 techniques that we have talked about in our previous sessions. So technique number 1 that we talked about was to extend the duration. Technique number 2 was to create an unchallenged side, or if you already have an unchallenged side, you roll up or roll down. Technique number 3 was to go inverted, and technique number 4 was a combination of all the 3 techniques. I am not going to get into the details of these techniques in this session. So if you have not gone through these 4 techniques, I would highly recommend you stop right here, go back, watch my other videos on option trade management, familiarize yourself with all those 4 techniques, then come back to this video. Alright, I am assuming you know about these techniques, so let's move along. Now, the crux of the topic is when to kick in these management technique. Now I would like to address this particular topic based on two high level categories. One is we can decide when to start managing our option trade based on the stock price movement, means your underlying stock has started to move and how much has it moved. The other way to think is how many days are remaining until expiration in your trade. So these are the two areas through which we will analyze when to kick in the option trading management techniques that we have already read about. So I will take an example of a strangle in this case. So as you can see, we got a strangle here, and let's say you started the strangle when the stock was at $28.5 and it was a perfectly balanced strangle. You had a short call at 30, you had a short put at 27, so your outlook towards the stock is neutral, and when you started the trade you had zero delta in this trade. Now because it's a short strangle, you collected a premium, so your break even based on the premium is say around $1 of a premium, so your break even point is at $31 on the call side and $26 on the put side. Okay, all right, so when you started the trade, stock was at $28.5. Now let's say a day later stock moves, let's say it moved to 29. Now the big question is, should I start to adjust my trade because the stock has moved? Or it could go to 29 and a half. Should you start to adjust your trade? We all know that stock is not gonna stay on one particular price. That's the nature of the game. Even though when you started the trade the stock was at 28.5, but after that it's been continuously moving. It could go down, it could go further down, it could come all the way here. So is this a right time to adjust the trade? I would say no. So now I'll take an example that a call is being challenged, means the stock is moving higher than when you had initiated the trade. So it comes here, let's say 29 and a half. You don't have to manage the trade yet. Let's say it hits your short strike. Do you still need to manage? I would say no. Now it is beyond your strike, your short strike. Now this is a time when you should kick in your management techniques. So for an undefined risk trade, in this example it's a short call, you should kick in your management techniques. You should start to manage your option trade if the stock crosses the short strike. So in this case the stock is challenging us on the call side. Once the stock rose beyond $30, that's when we will start to manage our trades. If the stock price is below $30, we don't have to worry about it. Now what should we do if the stock has moved beyond 30? We will apply technique number 2. Since it is a strangle, we already have an unchallenged side, which is our put. So we will roll up our put. We should roll up the put to reduce the overall delta of the trade by 50%. Okay. Stay with me for a minute. Let's explain what do I mean by this. So now when you started the trade, it was right dead in the center. It was perfectly balanced. You had a zero delta in this trade. Now when your stock has moved all the way beyond $30, now you have a negative delta in this trade. So at this point your trade is, let's say it's close to 50 delta. You have a negative 50 delta Now in this case you should roll up the put to collect positive 25 delta, because if you roll up your put and collect positive 25 delta, then the overall delta in the trade will be reduced to 25. Means from negative 50 it will now be negative 25. So you have cut down, you have reduced the delta by 50%. And the obvious question is, hey, why not reduce the delta back to 0? Roll it up further so that we do not have any delta and we are back to neutral. The reason is, it's a nature of the stock to go up and down, and we don't want to be overly aggressive at this point of a time to start managing it. And if the stock comes back down, we don't want to be getting challenged now on the put side. We are retail traders. We do not have a capacity to sit and watch our trades throughout the day. So we want to be setting up our trades and our management techniques in a way that does not warrant us to be always monitoring our screens. So I don't want to be really overly aggressive, because that means if a stock turns around, I will start immediately getting challenged on the opposite direction. We don't want to do that. So this is how you do. Now if your short call was at 30, your stock is here, then you roll up your put from, say, 27 to maybe 28 and a half. So you're not going all the way to 30. You're going only till 28 and a half, and that will still give you some more room. If a stock comes back, it will not challenge your short put immediately. Okay. Now because you have collected more premium by rolling up your put from 27 to 28 and a half, your break even point will be expanded. So instead of the break even point which was at earlier 31, your new break even point will now be, say, at 31 and a half, because you got 50 cents additional credit by rolling up your put. Now you have extended your break even point. That means the stock has got a little more room to run upside. If it continues in this direction, we might still exit the trade in profit, even though if it goes outside of our original break even. Right. And you should only roll up the put if you are able to collect additional credit. Again, we have talked in length about these techniques, on how to do the techniques, so I'm not going to focus on this one. I'm only going to focus on when to kick in these management techniques. Okay, so this was an example of a short call being challenged. Let's take an example of a short put being challenged. Again, we start with the same strangle. We started with the very neutral strangle. Stock was in the middle, and now the stock has started moving. It could move all the way here, it could go all the way here, we don't care. It could come here. Should we start to manage it? No, not yet. It is still far away from our short put strike. It is here. Should we manage it? Not yet. Let's say it comes here. In that case, we will kick in our management technique, and in this case the management technique will be to roll down your short call. Again, same concept. Roll down the short call to reduce the new delta by 50%. Now your put side is being challenged, so you'll have a let's say a 50 delta instead of negative 50 delta. Now you have a 50 delta, and now since you have a 50 delta, you should roll down your call to collect negative 25 delta, so that your overall delta in the trade is only 25 and not 50. You should reduce the overall delta in your trade by 50%. So that's how you manage an undefined risk trade. So in this case, I have taken example of a short strangle, but if it were only a short call or a short put, you will still apply the same technique, the same process. You will start to manage it once it starts to breach your short strike. Okay. Now the question is, how many times should I adjust? Should I adjust it once? What if the stock continues to challenge me? If the stock continues to challenge you, you should continue to manage it within a reasonable limits. I mean, if a stock, let's take an example of a short call that was being challenged. Now the stock was at 30, just outside our short call strike, and we roll up our put to 28.5. Now let's say stock moves to $30.75. Should you move up your put at this point of a time? I would say no. But if your stock moves out to 32.5 or 33, maybe then you should move your put up, because it has made a lot, a reasonable movement in the stock. So we have to give ourselves buffer so that even if stock comes back, we are still profitable. So don't be over aggressive, but yes, catch up with the movement in the stock within a reasonable limit. Okay. And if stock continues to challenge you, sometimes you may have to go inverted. Now, to understand what do I mean by going inverted, please go back and refer to the session in which we talked about technique number 3 for option trade management. Alright, so till now we've talked only about the stock price movement. But remember, I also said the other way I want to look at it is days to expiration. So how about that? Let's say when the stock is challenging you and you have less than 21 days to expiration in your trade. The stock had been cooperating, hasn't been making a lot of movement for most of your time, but now you have only 20 days to go, and then the stock really moved a lot. Now if your trade has less than 21 days to expiration, then instead of trying to roll up the put side, maybe just try to roll out the entire trade to the next expiration period. Means you will close your short call and the short put, and then you open up a new short call and a short put for the next expiration period, but make sure you have the same number of contracts, and you could use the same strike price if you still have this, maintain your outlook on the stock what you had when you initially created the trade. But if your outlook on the stock has changed, then you may want to change some strike price, but make sure you are doing it for a net credit. Now very important to see that you have the same number of contracts, because only then you can keep your risk the same, and because you have collected additional premium, there are high chances that if a stock comes back and cooperate, you will exit for a profit, or if it doesn't cooperate, you have actually reduced your overall loss without adding any additional risk. Okay. So if it is less than 21 days to expiration, you roll out your trade to the next expiration period, technique number 1. If it is more than 21 days to expiration, then you can use the techniques that we just talked about of managing the trade. Now, on what option trading strategies can you use this technique? On most of the undefined risk trade. For example, naked call, naked put, or a strangle. Now straddle is a peculiar case that even though it is undefined risk, but you will not use this particular trigger point to start managing your trade, because straddle means you have your short call and a short put at the same strike price, and the moment you put the trade on, stock will move and one of your side will be challenged. So for straddle, we don't start to manage the trade the moment your short strike is being challenged. For straddle, we wait until the stock crosses the break-even point. Remember, for us, when you do a short straddle, you are collecting a lot more premium, so you have a lot more buffer than on the other trades. So that is why we don't start to manage straddle immediately when the strike price is being challenged, because you will get challenged within a seconds of you putting the trade, because stock will move. So for straddle, you wait for your stock to cross the break-even price and then you kick in the management techniques. Alright, that's all I wanted to talk about. So quick takeaways is when to kick in your management techniques. If it is more than 21 days to expiration, then you start kicking in your management techniques. You create the unchallenged side. If you do not have, if you already have an unchallenged side, then you roll it up or roll it down. Now, by how much should you roll it up? How aggressive should you start to manage it? Roll it enough to reduce the extra delta that you have gathered by 50%. Or if you have lost deltas, then you add additional delta so that you can reduce the lost deltas by 50%. Basically, reduce the risk by 50%. Now, you can do it multiple times if the stock continues to challenge you. But if the trade has got only 21 days or less to expire, it is always better to roll it out to the next expiration cycle for a credit, and because you got credit, it reduces your overall loss, or it gives you more probability to close the trade in profit, and you got more time to be right. The reason 21 days is because after 21 days to expiration, the gamma really starts to kick in. So the risk and the reward ratio of staying in the trade really start to go against us. So the amount of premium left, amount of money you can make for per unit of risk you are taking, starts to reduce after 21 days. And that is why for us as a retail traders, we should start managing and closing our positions by 21 days. Now, when I say 21, it does not mean that this is the line in the sand and you cannot do it a few days before or after. It's okay if you can still close and roll it out on 18 days, by 15 days. But start becoming active and start to manage when you're close to 21 days. That's the whole point. Because your risk reward starts to go against us, and we don't have a time to open up every day morning and start looking at a trade every hour to see how it is going against us and how much do we need to manage. So use a ballpark of close to 21 days, start to roll out your trades. Okay. All right, that's all for today's session, and thank you for attending it. If you have any further questions, drop me a note at optiongig@gmail.com or write your question in the comments, and that might give me an idea for our next session. Thank you. Have a wonderful day. Happy trading.